It is a real treat to moderate a conversation with Abby Joseph Cohen. Now, there's much I can say about Abby since her resume is about this thick, but I will tell you some things that I'm most proud of. First and foremost is getting her here. She has been teaching for several years a class with my colleague Pierre Yarrick on the future of the global economy, which is a terrific course. She now is a professor here at school. It always thrills me to see that in the mentions in the Barron's Roundtable and on television. Abby, of course, has been a legend at Goldman Sachs in many storied positions, including U.S. Investment Strategist Chief. She has been active in a number of not-for-profit organizations, including Brookings and the Jewish Theological Seminary and Weill Cornell Medicine. We're going to have a conversation today on global markets outlook, a little bit on the economy, but I warn you to be thinking of your own questions, because after Abby and I chat for a while, I'm going to turn to you. So please, at the beginning, please join me in welcoming Abby. So let's dive right in. Nothing going on. Nothing in the economy, markets, politics. So let me start with the interaction, if I might, between the economy and the market. So on the one hand, GDP growth seems relatively robust, maybe even ahead of what the economy's long-term potential is. The job market's showing signs of cooling. We've got a new piece of data today on that. So where are we in the economy now? Let's choose some choices. Are we still too hot and we need more policy cooling? Are we in a very sweet spot of a soft landing? You know, the Fed did everything right, as it were. Are we headed for a recession, or is it something else?
Glenn, first of all, I'm delighted to be here, both at Columbia and in this room right now. And you are absolutely right. This is such an interesting time for this kind of discussion. And I want to back up a little bit before I answer your question about where is the economy now. If you had asked the average economist, the consensus, 18 months ago about what was going to happen to the U.S. economy near term, the presumption was there was going to be a recession. And you and I did a class, a group like this, in which I said, I don't agree with the consensus. I thought recession was in fact very unlikely 18 months ago. Why? Number one, even though interest rates were beginning to rise, they were starting from zero. So yes, the direction of change may not have been all that constructive for the economy, but if you're going from 0% cost of capital to cost of capital that's still kind of low by historical standards, not a big problem. Number two, the consumer balance sheet in the United States was exceptionally strong. During the pandemic, people just were not spending. So those of us who were fortunate enough to still have income, we weren't spending very much, our savings rate went up. And those people who were having problems, perhaps they lost their jobs, perhaps they were low income, they were getting subsidies from the federal government, and that in fact also boosted the savings rate. So 18 months ago, we had a situation where interest rates were starting to rise, but from very low levels. The consumer balance sheet was extremely strong. Number three, corporate profits were quite robust. That surprised many economists and analysts. And I can go on in terms of describing the underlying strength of the U.S. economy then, which could tolerate changes in what the Fed was planning to do. Where are we now? Back to your question. We now see that the consensus has moved away from the recession forecast. They've decided that maybe they were wrong, and so we now see that the consensus largely favors ongoing economic activity, no recession any place in sight, and I have to tell you, I disagree. I think the probability of recession has in fact risen. I don't think it's the most likely scenario over the next 6 or 12 months, but I think the risks are increasing. Why? Number one, the consumer balance sheet has now deteriorated. We see that there's been a lot of uptake of credit by the average household in the United States, and that gives us less margin, less cushion. Number two, as you point out, the labor markets are cooling off. They're still okay, but we're no longer in a situation where there are 2 available jobs for every person looking for a job. We also know that we are facing a situation in which inflation is in fact rising. Some of that is related to wages. I, for one, applaud that. We have gone through a 20-year period in which wages were not keeping up, and now they are. So from my standpoint, I'd like to see that incomes are rising. However, we see that there are other elements of inflation that are also now getting baked into the situation, and we now know that earnings are under more pressure. We turn our attention to the rest of the world, there are also things to be concerned about. Parts of Europe are in recession. Germany is in trouble. China, the Chinese economy is in trouble. And so the global economy is not as vigorous as it was. And I always look at things in terms of, is there a buffer? Is there a cushion? And I would say there's less of that. So should there be some unfortunate events, economic or otherwise, we have less margin for error. And if I can just add a quick postscript, why is President Xi of China meeting with President Biden now after these very difficult public comments that have been made over the last couple of years?
The lunch menu looked awfully good yesterday.
It did, didn't it?
I don't know if you all saw it.
Yeah, absolutely so. A very friendly, productive meeting according to the readout from both the Americans and the Chinese. But why now? The Chinese economy is in trouble. The Chinese financial markets are in trouble. There is a collapse in real estate market in China. I can go through the whole litany of problems that China is facing, and they're basically saying, we'd like to see what we can all do together. So things that became extraordinarily difficult a couple of years ago in terms of conversation between the 2 countries, including things that shouldn't have been difficult, including climate change, all of a sudden they're back on the table. And I think it's in not just the best interest of the US and China, but the rest of the world, just given the importance of these 2 economies and nations.
How do you map that outlook into an outlook for the US equities? You touched on several things that would impinge on equities, not all exactly in the same direction. Net world.
Net, it is not a straightforward answer. I always like to look at valuation. You could have a beautiful scenario out there, and you really think it's the most likely, but if it's already priced in, as an investor, I want to be concerned. On the other hand, you can have a situation as we did in March 2020, when it became clear we had a huge problem with COVID, when markets overreact. So the economic outlook was not all that favorable, but what was priced into financial markets was so much worse, that was actually an opportunity. When we look at the situation right now, Glenn, I say it depends upon which market you're looking at, which asset category, for example. In equities, I believe that there are areas which are overpriced. As you and I have spoken, there's that magnificent 7, those 7 stocks that everybody had to own, most of them technology related, that really have taken the lion's share of capital coming into the market, and those valuations are not appealing. If you look at other portions of the S&P 500 or other indices that you might be interested in, you see that there is a very wide gap between sectors, economic sectors, and even within sectors by industry. So for example, financial services right now looks kind of attractive. Heavy-duty industrials look kind of attractive on a valuation basis. And again, I'm looking at the underlying fundamentals of those companies. What do their profit margins look like? What do their earnings prospects look like? What do their revenue prospects look like? And is that priced in? We also need to turn our attention, very importantly, to the fixed income markets. For about 30 years, investors just could assume that interest rates and inflation were under very good control. And then, of course, as interest rates have moved up over the last 2 years or so, fixed income has been much more of a difficult place to be. You all know that as interest rates go up, bond prices go down. But it's not spread across, right? There are differences in performance in various types of bonds. There are many people who would now argue that municipal securities look attractive, that the emerging market credit areas look more attractive than the developed markets because they have a higher risk premium built in, and so on and so on. But I would tell you that one area where I am really nervous has to do with the private markets. Private equity and also private credit. Private equity was where everybody wanted to go, and what we discovered is that some of the returns that were being reported out by the managers were a bit of an optical illusion. You had managers who were okay managers, not necessarily great. Maybe they were making a 25-cent profit, but they levered it up 4 to 1, they reported out $1. Well, you can't do that as easily when interest rates have risen and your cost of capital has gone up for these private equity managers. Similarly, many of the underlying companies in these portfolios are themselves facing problems because on an operating basis, they're also paying more for their capital. So we see that some of these mediocre companies may not make it, and some of the mediocre managers are reporting out performance data that's not that attractive. I spend a lot of time working with endowments, pension plans, and so on, and I will tell you that the professionals who run those investment offices, they have culled the list of managers that they want to deal with. Next up on my list of concern is private credit, because that's the new hot thing. Lots of institutional investors want to go into private credit, but I think you're going to run into the same problem that we ran into with private equity. By the way, there's way too much money going into private credit. If you take a look at international flows of funds into the United States, we see that one of the main targets for sovereign wealth funds coming into the United States right now is private credit. That makes me nervous.
I want to take a minute to geopolitics, but you touched on rate issues a couple times, so I want to come back to that. So Chair Powell, at his most recent press conference, seemed to pour cold water on the idea of imminent rate cuts. Yesterday, we get some good upbeat news on inflation. Markets are super excited. Where's the funds rate going over the next year and the 10-year treasury?
I think the most likely thing is that the Fed just sits back and waits to see what happens. I think it will take a long, long time before they actively lower interest rates. I don't think they should be lowering interest rates right now, but you should be watching, as we all will, in terms of what does the market do? Keep in mind that before the Fed started to raise interest rates, the markets were raising interest rates, right? The market can't raise the Fed funds rate, but markets can sure raise market rates, including the 2 years, the 10 years, and the 30-year bonds. Something over the last few days I've been watching has been that long yields in the United States have actually ticked down a little bit. The dollar has weakened a little bit. And when we look at fixed income markets, sometimes we forget to look at the FX markets. The dollar right now has benefited, if you will, from a very strong run in recent months, and I would suggest that that's probably going to ease up a bit.
Okay, let me take you to geopolitics. So both the ongoing conflict in Ukraine and the emerging terrible conflict in the Middle East, walk us through further implications both for energy markets and the global equity risk premium.
those are very important questions, and I'm going to add one more piece having to do with domestic politics.
I want to come back to domestic politics.
But domestic politics as it relates to Ukraine and,
Oh, okay.
and the conflict in the Middle East. For everyone who's been cheering the new budget and the compromise that was reached under Speaker Johnson, what everyone has sort of not paid enough attention to in my mind is that this is a two-step process and it's not over, right? The Senate last night did vote in favor of the bill that was passed in the House. And it was passed in the House with enormous support from the Democrats. But the Republicans who were responsible for throwing out Speaker Kevin McCarthy and for making it impossible until just a few days ago to select another speaker, they all voted against. All right, this to me is not a good, stable situation. Also keep in mind that Speaker Johnson's proposal came in two parts. The Congress has not yet approved the defense spending. This to me is incredibly dangerous. It affects the defense spending by the United States, and of course, the proposal that went to the Congress from the White House had enormous support for Ukraine to the tune of about $60 billion. That's not in the budget yet. The president asked for $12 billion for Israel. That's not in the budget. He asked for approximately, if I remember the number correctly, $5 or $6 billion for Egypt and for the Emirates. And he also asked for approximately $4 billion in humanitarian aid in the Middle East. None of that has been approved. So we are still in the middle of trying to get this resolved. Now, let me answer the specific question on markets. It's kind of remarkable, given the conflict in the Middle East right now, that energy prices haven't gone up. They went up very briefly at the beginning of the conflict, and they're now back down. And I would suggest to you that if the energy-producing nations in the Middle East were really very upset by what they were seeing, they would message that by cutting back energy supplies, which they have not done. They have not done that. And there's one argument that says, well, you know, the United States is now sort of energy independent, and so there's less leverage there. The reality is that Europe is not energy independent. Energy prices haven't gone up in Europe either. So I think that we have to distinguish between what many of the energy producing nations in the Middle East are saying publicly, particularly for the street, if you will, versus what they're actually doing under the surface.
The street being the street in their own country, not
the street in their own country, yes,
yeah.
Thank you for the clarification. If we take a look at things like currency, CD spreads, and so on, what we see in Israel is that the shekel went down, but is now in the process of recovering somewhat. And then, of course, we look at the equity markets. And for anybody who's interested, equity markets around the world, including emerging markets, have been pretty stable during this period of time. The Israeli market, not surprisingly, down about 5%, more than the others. But there has been a fairly muted reaction to all of this. My own concern from a geopolitical standpoint is that I think we need to better understand the connection between what's going on in Ukraine and what's going on in the Middle East. So much of it being directed by Russia and by Iran. The weapons that are being found in the Middle East, for example, are Russian and Iranian, and also North Korea. So a lot of this is connected, a lot of it aimed at destabilizing and also making the West feel uncomfortable, which of course we all are.
Do you think equity markets have priced all that?
I think that equity markets, with regard to Ukraine, which was the first question, priced it in at the beginning, and now they often forget to talk about it. The exception would be some of the European equity markets, where I do see that the markets in Germany, for example, are reflecting it. But there seems to be not much dialogue in the United States about the situation. With regard to the crisis in the Middle East, investors in the United States are not big investors in the equity markets in that part of the world. The greater interest seems to be the flows of funds that come from the Middle East to the US and to Europe, and thus far we're not seeing any diminution of those flows.
I want to take you back home to the US, although what I'm about to ask certainly has global implications too. In a sharp departure, industrial policy is back, and it's back with a vengeance. When I was the age of students in the room, it was a hot thing. It went away for decades. Now it is very much back. Now, have we seen the full shift impact there in markets? We're seeing hundreds of billions of dollars of targeted subsidy spending, Inflation Reduction Act, the CHIPS Act. Are markets on top of that? And who are going to be the winners and the losers from this kind of political shift?
That is such a big question, and I suspect that you and I might have some differences of opinion on this. And I would basically say that the United States has always had industrial policy. Going back to the beginning of the 19th century, when the federal government and various state governments funded the canal system. That was the way that the Midwest opened up. The funding of the railroads in the 1820s, funding subsidies for tobacco and for energy companies and so on. We didn't call it industrial policy, but there it was. But you are absolutely right. We are now seeing industrial policy on steroids relative to what we have seen over the last few decades. And while none of the bills are perfect, I actually find myself in general supportive of what's been done. So what's there? Number one, there was the CHIPS Act, which is aimed at making the United States more self-sufficient with regard to the production of things like semiconductor chips. I think that US industry and the government took its eye off the ball when we became highly dependent on foreign manufacturers for this, because these are in fact critical, not just to our economy, but also to our military and so on. It's going to take years before anything happens, but I like the direction. Number two, the spending on infrastructure. I happen to think it's long overdue. One of the things I wrote for Goldman Sachs in my last year there was a review of US infrastructure. Anybody know what the grade for US infrastructure was from the Society of Civil Engineers? Totally non-political group. They gave it a rating of a D+. D+. The world's largest economy, the world's largest, wealthiest economy. I don't know. I went over quite a few potholes getting here today. The airports are not in good shape. Now, part of the problem is that we built our infrastructure well before other nations, and so we are now at the point where we have to fix things, and fixing things isn't sexy, right? It costs a lot of money. It could take 10 to 20 years for some of these projects to be concluded, and who wants to spend the money on it? Also, if you happen to be the mayor of a city, for example, like New York, and you go through all of the efforts to get the permits, to get the financing and so on, you're not going to be mayor 20 years later when people benefit from it. So throughout the nation, we have really allowed our infrastructure to deteriorate, and I think it's time that we spend the money to fix it. Now, who are the winners? Who are the losers? I'm going to answer it from a non-Wall Street perspective, and that is the winners are in the communities where the money is going to be spent. Most of the money, oddly enough, is going to be spent in the infrastructure area, is going to be spent in semi-rural communities that are largely Republican in terms of their voter registration. I say this may surprise you because this was a bill proposed by a Democratic president and passed at that time by a Democratic Congress. Why the money there? Because the feeling is that that's where the need was. There wasn't broadband access. In a city like New York, we have broadband access. 90% of the population has easy broadband access. In some of these communities, it was under 20%. You cannot have a functioning economy in the 21st century without functioning broadband. You hear all of these things about farmers buying this really cool equipment where they can log on and they'll know what the weather's going to be, what fertilizer they should put down and when, what seed they should put down, et cetera, et cetera, et cetera. All of the decisions about irrigation. None of that works if you don't have broadband, right? You also can't build new industries like call centers in these communities. So when I take a look at who are the winners from this spending, a lot of it is areas of the country that are actually below average income because they've not had good employment prospects. People are not well paid in these communities. The other areas, the beneficiaries from a Wall Street perspective, include a number of the technology companies, a lot of the industrial companies as well, companies that do construction who benefit from the infrastructure spending. And the answer I would give just from a policy perspective is we all benefit. If we can bolster our D plus to something better than that, I think that the rest of the economy does well. There is a real economic cost if you can't get to the airport easily. There is a real economic cost when all of us have to replace the suspensions on our cars every year because of the damage. There are real economic costs for not having an appropriate transportation system, communication system, and so on. So I think this is money well spent, and when I use that expression, spent, I view this as an investment, not outright expenditure.
Let me take you back to the domestic politics that you mentioned earlier. To put it mildly, the House of Representatives is dysfunctional, although I will note, apparently they're about to toss out George Santos. Progress happens.
That's because if you've not heard the ethics panel
It was
finally
pretty bad,
agreed,
yeah, it was
really
pretty bad.
yeah.
And we add to that, of course, the United States Senator threatened someone with a fist fight in a hearing the other day. Putting aside the theater and the civics implications and all that, talk to me about markets. At what point do people start worrying the treasury market, the dollar market, from an inability of the political process to deal with any of the problems we've been talking about?
I, for one, have been surprised at how calm the financial markets were over the last few weeks, given, as you put it, the dysfunction primarily in the Republican Party. I think it's a testament to two things. Number one, the underlying strength of the U.S. economy, and number two, people hearing the same story over and over again. The first time a shutdown was threatened, there was a very strong reaction in the financial markets. This time around, people said, been there, done that. So we know what's going to happen, and I actually think it was an underreaction. Should there be, in February, when we have to deal with the budget issue again, a potential threat of a shutdown, I think it's going to be more significant then, Glenn, because of the parts of the budget which haven't been dealt with, which are defense-related and things that are very significant. Let me just make the following comment, because it drives me nuts when the media doesn't get this right. Spending for Ukraine, that spending gets done here, right? It's equipment and material that is built in the United States and is then sent to Ukraine to protect Ukraine from Russia. Same is true for the spending, the $12 billion that was intended for Israel. This is all benefits money that's spent in the United States. And the other one that I find so vexing is NASA funding. Why are we spending money on Mars? We're not spending money on Mars. We're spending money in Houston, Texas, Huntsville, Alabama, throughout the United States. There are like 15 different states that are involved in getting this Mars project off the ground, pardon the pun. So we have to be more honest and thoughtful about who actually benefits from the spending.
Let me ask one more question from me for now. It's a cue for you all to be thinking. We've got a $2 trillion federal budget deficit in an economy that I think we would agree is relatively healthy. This is not tough times by any sport of the imagination. And underneath the hood, it's worse because we have structural budget challenges that just aren't going away. In fact, they're going to get worse. For a while now, the bond market has been quiescent. Nothing I've said is new. The 2 trillion number is new, but nothing else is new. Do you foresee at some point any kind of bond market challenge or reaction to the inability of our political process to deal with these sorts of structural budget issues?
There has to be, because we are marching into a very difficult situation. And for those who are not familiar with where that structural deficit comes from in the United States, a good deal of it has to do with the aging of the baby boomers. I apologize. And it's not Social Security. People have paid into the Social Security system and we know how much they're going to receive. The real problem is for Medicare, because Medicare expenditures are not limited. And so with very rapid inflation in medical costs, that has really created an enormous problem. So how do we deal with it? Number one of the things that has been addressed partially in legislation under the so-called IRA is to try to get medical cost inflation under control. As it turns out, Obamacare has been helpful in that regard as well, but we still will have a mismatch. And I do worry about it. And I worry about it in large part because there's not really an honest conversation about what's happening, number one. Number two, what have other countries done when they are facing big debt overloads? They inflate their way out of it. Because if you have debt that becomes worth less, if you will, because of inflation, that makes it easier for the government to pay it down. I have been comforted thus far that we don't really see that as a plan of action. I think that the Fed has made it clear that they're going to do what they need to by continuing to focus on inflation. And I'm hoping that we don't, as a nation, basically, chuck it all and say we're going to take the easy way out here. I think there are tough decisions that have to be made. And I'll make one other comment as it relates to the big spending for older Americans. I know that there are many older Americans who need the assistance. And I think needs-based and so on, income testing is fine. What I worry about is that we're shortchanging young people. We ought to be investing in education. We ought to be investing in infrastructure. We ought to be investing in things for the future. We ought to not be spending as large a percentage of our budget on basically retirement systems.
Couldn't agree more. I just tease. I have a report that I and some others are writing. We're coming out soon on trying to shift the economy away from a consumption society to an investment society, from old people-centered society to a young people-centered society. Too much of our discussion of political economy is really on little issues, but we've got some big ones to deal with. I certainly have other things I could talk with Abby about, but I want to open it up to you. Questions, and do we have a mic too if somebody has a question? Question for Abby. Yes?
I think the program she's going to give us her wisdom about 6 investing ideas. That would be fantastic. That was listed as part of the program. If you could go through the 6.
Yep. Do you have a list of the 6?
I'm David Letterman-like. I have 10.
Okay. So one of the at the top of the list were a number of things that have to relate to investing, and then at the bottom, I was asked to put some things having to do with career. With regard to investing, I think one of the most dangerous things is, as everybody now refers to it, FOMO, fear of missing out. And this used to be referred to as momentum investing. Invest in what's already doing well. And I consider this to be one of the most dangerous things in any market. And so within the last 2-3 years, you've seen this in terms of everyone moving into the same technology stocks. You see it in terms of people going into crypto. You see it in terms of people investing in things they don't quite understand. They just know that they've already performed well. And this to me is truly dangerous. I think that real investors, and I put all of you people in that category, because here you are studying things seriously, learning about valuation techniques, learning how to analyze appropriately. When something sounds too good to be true, it usually is. And that to me is very disturbing. Now there are some structural reasons that we've had FOMO. Glenn and I have discussed the damage that has been done by moving too much in the way of indexation. With indexation, we have seen that the stocks that have done well in the past are the ones that get more money coming in, and they just become more and more inflated. Now, we all talk about the 7 tech stocks now. This has happened before, right? When I was in your position, learning about markets, one of the big stories was the 1960s. There was something called the Nifty 50. In reality, it was the Nifty 5. IBM, which was then the fair-haired company, I was asked by my employer at the time to do an analysis if IBM would continue to grow at the rate that the consensus expected. And my calculation showed that within 10 years, it would be about 60% of GDP. That didn't make sense, and a lot of what we see now, it doesn't make sense either. Were there others on that list that you wanted me to talk about? I'm happy to do that.
I think you talked about people misinterpreting the data, just the whole list sounds super interesting.
Sure. Yeah, with regard to misinterpreting data, I'm an economist and computer scientist by training. I like to dig into stuff, and when I was a junior economist at the Fed, one of my jobs was to figure out ways in which the data were wrong that were being used, and ways in which all these sophisticated econometric models might be wrong. So I always start looking at data sources saying, okay, what's it really telling me? And here's one thing that I believe is not well understood and certainly not well explained even in the financial media, and that is that most of the economic data that we receive, it's not accurate, right? It's just not accurate. It's based upon sampling techniques. So if you're looking at GDP data, for example, please understand that the weightings assigned to everything is based upon what used to be important 5 or 7 years ago when it was put together, and it's not based upon every company. It's based upon a handful of companies that are surveyed, and they're assigned a weight based upon how important they were 5 or 7 years ago. Is one of the reasons why GDP, for example, was grossly underestimated in the 1990s. Because the GDP calculations done by the Commerce Department were looking at these old line manufacturing companies, and they weren't looking at the technology companies that were just becoming important, whether it was Intel or Microsoft or Apple. They just weren't even included in the surveys. And we have similar problems right now. If you want, I can go through some of my favorite bugaboos. But one of them, has to do with the way we look at inflation. Our inflation numbers are wrong as well. It's, CPI data is based upon a basket of what everybody buys. All right. So if you go into the supermarket and you decide that, oh my God, iceberg lettuce is too expensive, By the way, I don't think anyone should ever buy iceberg lettuce, but if you think iceberg lettuce is too expensive, and therefore this week I'm gonna buy romaine, what gets counted in CPI is that iceberg lettuce, not what you actually bought. You know, so we have to understand what it is we're looking at when we look at these data. And by the way, US economic data, I think, are probably far more accurate than anywhere else in the world. So put that into your head for a while. We just don't know the reality of the situation. Here's a little factoid for you. Do you know when we get the final GDP numbers for any particular year? 3 years later. Because the Commerce Department, trying to get the information correct, keeps adding more and more info. They ultimately look at the tax returns of companies to see what was produced and so on. But 3 years later, nobody is looking at the data. What matters is what gets reported at 8:30 in the morning, how do markets respond that day, and Glenn made the point before about we have data and information that was released just over the last few days. Everybody's already forgotten about it. You know, again, as a trained economist, I try to remember what's really in the data, and that to me is critical.
They still have iceberg in the Crowder's Deli. I had some for lunch, so I know that to be true. Other questions for Abby? Yeah.
There was a debate over the summer about long-term neutral rates and R-star in general. I'd love to get your thoughts on whether you think, R-star has in fact risen, and what might be the drivers moving forward for putting upward pressure or downward pressure on R-star.
Mm-hmm. As a former Fed person, I love a question like that. Let me bring it down to a somewhat different level. And that is, I think that for way too long, market interest rates were way too low. There were a number of reasons for that. Some of it having to do with not just Fed policy, but central bank policy around the world. You had European central banks, for example, that actually had negative rates. I'm not talking about real inflation adjusted. I'm talking about nominal. That's kind of a crazy thing. So I think you had inappropriate central bank policy around the world for a long period of time. Add on to that the idea that inflation really was low. And we ended up with a situation in which I think the capital markets were way out of whack. And so to have interest rates that are too low for too long, I think has led to a significant number of problems. I mentioned a couple before, capital going to companies that didn't really have good business models, capital being used by financial firms to lever up, and sometimes lever up decisions that weren't so clever, a willingness on the part of investors to fund all kinds of things through private equity, through venture capital, and what did that mean in terms of any number of financial institutions that were not sufficiently protective, Silicon Valley Bank, Signature, et cetera. So when we see that our star has adjusted, equilibrium level of interest rates and so on, I think where we are now makes a good deal of sense. We have not yet seen, for example, that there has been a very harsh reaction in the real, i.e. the productive side of the economy from this level of interest rates. We've seen it in financial areas where they had taken advantage of ridiculously low yields. But we see, for example, that many companies with good business models are continuing to perform well. We see that real estate has been hurt, but mainly hurt in areas that one could argue were kind of like overdone to begin with. So I think we're just now at the point where we're seeing interest rates starting to pinch on a real economy standpoint.
Questions? I see it, yeah.
Thanks. You talked a little bit about FOMO and, in general, certain sort of waves of investment ideas like crypto and et cetera. I guess, what are your thoughts on AI being an industrial revolution, and what are your thoughts on the growing population of the world and the fact that climate and sustainability are, these are probably two different questions, but climate sustainability.
Really big questions.
Climate and sustainability tech, just curious to get your thoughts on both.
If you could add the meaning of life.
Well, let's do the second one first, climate. I have been fortunately in a position where I have been working on the climate issue from a financial market and business perspective for about more than 20 years. When the United Nations did their first summit for investors and business people on climate, I was one of the, what they refer to as conveners, and representing Goldman Sachs. And we actually committed a great deal of effort to studying this over the last 2 decades. I believe that the world is first recognizing, finally, the severity of this. And I'm going to speak like a Wall Street person for just a minute. The problems are finally coming to the fore in the minds of many investors because of the incredible economic damage that is occurring. If you look at the largest climate disasters over the last century, 90% of them have happened in the last decade, right? It is really kind of stunning. Some of them related to wildfire, some of them related to flooding, and so on. And so the insurance industry, by the way, was among the first to recognize the problem more than 20 years ago. Other investors, I think, have been kind of held back because there's been inadequate data. We tried to build a database under my aegis 12 years ago. We spent 2 or 3 years trying to build it. We basically found is we didn't have adequate data. Companies were not reporting the information. They weren't required to, by the way. When we tried to do comparisons across nations, it was almost impossible. The data quality now is somewhat better, and some of the preliminary work that's been done shows the following. And this is different than what academics would have told you 10 or 15 years ago. The standard academic analysis basically said those companies that were paying attention to climate issues did not have good performance. The portfolios that included these companies did not have good performance. At best, it was kind of neutral. They didn't really add any value, and in some cases, they lost value. If you look at more current information, what you find is that these portfolios now often do outperform. And I will speak to you as a business school person. If there is a mispricing in an asset, because no one is paying attention to it, of course, you're not going to see the kind of returns you should see. But now that we have investors, companies, and so on paying attention to it, you are seeing the return to this kind of approach. And so I do think, to answer your second, really small, really big question, that we are going to see more and more activity in this area on the part of investors and others. And I'm also very glad that the Biden administration reversed what the Trump administration had done. Under the Trump administration, the Department of Labor issued a statement saying, you cannot consider, this was to ERISA pension plans, you cannot consider climate as your building portfolio. And what the Biden administration has said is, yes, you can consider climate. Of course, your number one priority is to take care of the pensioners, the people whose money it is you're managing and so on, but yes, you can take this into consideration. Now, what was that other little question? AI. I'm going to say, with all humility, despite my undergraduate degree in computer science, I don't know the answer. I have spoken to any number of people who are computer scientists who specialize in AI, and have tried to figure out what the impact is going to be. And I truly worry about it. Glenn mentioned in the introduction that I'm on the board of a medical college here in the city. And we have underway a project using AI. We have put in accurate data on the patients. We have put in accurate data on what we know about various disease flows and so on. And when we run the AI, and it's just in pilot now, I don't want you to get worried about the patients. We do it in pilot, and we find that even with the correct information going into the system, we still see that the system hallucinates. You all know what that hallucination means in AI? Basically, AI is making it up, right? So even with the right data, there's hallucination. Imagine what's going on in AI systems that aren't being as carefully checked for the inputs. So I don't think this is ready for prime time. I know that there are lots of applications. You know, we've all been using AI to one extent or another. You know, those chatbots we've hated for the last 15 years. It's a form of AI. You know, my washing machine basically tells me, no, you didn't need 30 minutes in the dryer, only 20. That's a form of AI. But what we're looking at now, of course, is generative AI, and we don't really know how it works. And when I say we, I obviously don't know how it works, but when I speak to computer scientists who specialize in this area, they say they're continually surprised by what happens. Now, I suspect that one of the questions on everybody's mind is what happens to labor markets with AI. And I think it has been clear for many years, even without generative AI, that if you have a repetitive function in your job, you're in trouble. Whether that repetitive function is using a drill press, or whether that repetitive function is processing some form in a white collar job, clerical job. Or, I hate to say it, if you're a financial analyst on Wall Street and you're processing the same data over and over every single quarter when a company reports. If you have a repetitive kind of job, that's where AI can either be a problem or can be an assist. And what we have seen thus far is that it's usually more of an assist, particularly in the higher level areas, not in the lower level areas. The other function where there has been all this confusion, the strike for Hollywood writers and so on, is what about the creative arts? And that is something that is really kind of interesting. Where is the new creation going to come from? You look at some of the creative stuff that AI has done, make up legal briefs based upon things that actually didn't happen. That's kind of creative, but that's not what we're looking for. So I think we don't yet know the answer. I believe, again, based upon the conversations I've had with people who really know things, that for the next 5 to 10 years, we're going to see AI acting more as something that augments what we all do. And past that point, we don't quite know. And we certainly don't know what the pathway is.
I'm glad you didn't mention economics for in that list. But, do you all have a question? I've got a lightning round if you don't. Okay.
One last one.
I'm sorry, let's get a new person first, yeah.
Thanks for being here. Regarding the rise of private credit and its more, let's say, relaxed underwriting criteria compared to a syndicated loan, do you feel like private credit will one day become a systematic risk to the financial system?
I think it already is. And the reason I think it already is not just the manner in which the credit has been applied, but the way in which the information to the investors is being provided. I think that one of the attractions from private equity and private credit has been, oh, it's not volatile. Well, yes, it is. You're just not telling your investor how volatile it is because you're not doing a mark-to-market on a regular basis. And that worries me. I'm always concerned when there's not sufficient transparency. You know, it's one thing, maybe venture capital, where you don't really have mark-to-market on a daily or weekly basis. But in credit, you have much more availability of information. You should have more availability than is being reported out. And I think that because of that, you have a lot of sponsors, i.e. the people whose money it is, not knowing what it is they have. And I think this represents a risk.
Did you have one more quick question before I close this out with a question? Yeah.
Just on, obviously the US has a huge deficit and doesn't look like we're gonna be able to fix it anytime soon. So I think my question is both financial and geopolitical, but because of our relationship with China and the fact that the BOJ is potentially finally exiting zero interest rate policy, kind of what's the outlook for financing our deficits and what it means for interest rates in the US and the impact on the economy?
Mm-hmm. It's a wonderful question, and I would break it into time frame. In the near term, I'm not the least bit concerned because the United States still takes in a great deal of capital from other nations that have higher savings rates. Maybe they're not as high as they used to be. And also, the dollar is a store of value, right? We are the world's reserve currency, and we benefit from that. Whether we should or not, that's a different story, but we are the world's reserve currency. And we get a little bit of a pass because of it, just the way Great Britain got a bit of a pass for decades when pound sterling was the reserve currency. So on a near-term basis, I'm not concerned. Longer term, we need to look at not just the factors that you raised, which I think are absolutely correct. That is, the budget deficit is large. BOJ is going to be tightening up. We don't know what China is going to do. All of those are very valid. The other issue, though, has to do with, will we be moving to, let's call it, a basket of currencies? Will we be going into a situation where it's not just the dollar that's the world's reserve currency, but other currencies take up the slack? Now, I will tell you that several years ago, at the advent of the euro, there was great excitement that there would be a basket of currencies. It would be the dollar, it would be the euro, and it would be the Chinese renminbi. Well, we all know what happened. Nothing happened, right? Because the euro didn't quite pan out the way people wanted to because of poor performance in the economy, and the Chinese renminbi hadn't really caught on. Hadn't caught on because it's not a floating currency and didn't meet the other requirements, if you will, for being reserve currency. What has happened over the last handful of years? I think the Chinese have been much more clever about this in terms of requiring that many commercial contracts be done in renminbi. Now, if you're not aware of it, something like 90% of the dollar value, the commercial value of commercial contracts in Asia are done in dollars. Most of that has nothing to do with the United States. They're just doing it in dollars, right? Commodity contracts around the world get done in dollars. But what's happened most recently, we see that the Russians have been insisting that they're not going to do their energy contracts in dollars. The Chinese, once the United States pulled out of the Pacific Partnership, they have been saying to their commercial partners in Asia and in Latin America, we'd like to do the contracts in renminbi. Now, it's still not the lion's share, but it's rising. And so in phase two, answer to your question. I think these are the things to look at. If we get to a point where the dollar is no longer as commanding as it is right now, that's going to add extra pressure in terms of how we deal with budget deficit.
I want to ask you a final question, because the question came up earlier at the beginning about careers. We've been talking about markets today, and that's great, but if you were sitting in the chairs of an MBA student, what courses outside finance would you be taking to understand what you know, do, talk about in markets?
Tough question, and I will basically come back, Glenn, to something that you and I were chatting about earlier, and that is, what are we reading, right? I shouldn't tell you this, but I will. For years, my trick question when interviewing MBA students was the following. I wasn't asking them to do math in their heads. My colleagues were doing that. My trick question was, what have you read recently? And the typical answer was, oh, I read the Wall Street Journal. And I said, no. What have you read recently? And then the next response was, The Economist magazine? And I said, no. What have you read recently? And then there'd be the light bulb going off. You mean like a book? And I said, yeah, like what have you read recently? And so I know we don't have to read on books, in hard form, but what have you read to open your mind? And I think that's really your question. Among the things that you and I read are things like history, politics, entertainment.
Yep.
I would add to that, I read a lot in science, because I do want to be able to answer your question about AI sensibly. I do want to understand what's happening in the world based upon facts, not based upon hypotheticals that people may be raising. I want to base it on what's facts out there, and then try to use my imagination in terms of which way things might go. So to answer the question, I would say to people, read broadly. Read things that interest you, and read things other than economics and finance. Well, economics maybe, but because one other thing. Before it was called economics, the field of study was called political economy. And the great political economists, including people like Keynes and some of the other names that you may be familiar with, they studied history, they studied politics, they studied demographic changes, they studied issues about labor force and so on. So I think to think broadly is really the answer.
That sounds like a great place to leave it. Join me in thanking Abby.